Good afternoon. This is Lance Bryce with Thrive Mortgage. We're seeing interest rates significantly higher than they were this time last week. We're up, nationally, probably a quarter of a point or so. The Mortgage News Daily average has rates right at 3.25 for a 30-year fixed conforming. That's pretty much what you're going to be seeing on the street out there. But of course, call me for any specifics, and I'll be happy to run specific scenarios to let you know. Some folks are going to be a little bit better. Some folks will be a little bit worse, just based on what they're trying to do. Here's what moved the market. The Federal Reserve yesterday released the minutes of their meeting showing that they are beginning the scheduling of their tapering of their buying of mortgage bonds. The way the Fed has been keeping interest rates low is by increasing demand for mortgage bonds by buying them. You don't want to embarrass the Fed by asking them where they get the money to do that because, of course, they just print it. So when we talk about printing dollars, that's how the Fed's doing it. They just simply send a wire to the Chicago Board of Trade. They buy mortgage bonds and fixed income securities with those printed funds. Actually, they don't even go through the trouble of printing it. That is on its face inflationary. And when you add that to what our federal budget is doing with regard to spending, then you get more of the same. So we are deflating the dollar with these policies. And when the Fed announces an end to that, well, the market sees that as weakening demand for the purchase of mortgage bonds. That means lower prices, and that means higher yields. And those yields are our rates. So that's why we're seeing interest rates go up. We would have seen, I think, more bleeding if it weren't for a much higher than expected jobless claims that came out this morning, kind of stopped the bleeding. That bit of bad news hurt the Dow. We are seeing the Dow down significantly over the last couple of days, both over inflationary concerns and these jobless numbers. The bottom line is we can't really tell what side of the fence we're going to be on in the fall of this year or later this year. It's going to take several months to see are governmental policies going to put a damper on employment growth and thus slow the economy, which might tend towards lower rates, and the Fed having to slow their tapering? Or are we going to see the opposite? Are we going to see full recovery with the Fed having to tighten further? We just don't know yet. The bottom line is, until we have a better picture of it, the strong recommendation is for folks to continue to lock in the face of this volatility and to grab what are still very close to historically low rates. In any event, I hope this is helpful for you and for your clients. As always, you can reach me online at brycehomeloans.com, or you can call me on my cell, 210-260-9660. Hope you have a great week.